On Monday, during the Asian trading session, spot gold continued the weak oscillating trend from last Friday. After the morning opening, it gapped up by about $20 at one point, surging to around $4,988. However, the rebound momentum failed to continue. Subsequently, it oscillated and pulled back, gradually eroding the opening gains. Overall, it maintained a range-bound oscillating trend, with the long-short game remaining stalemated and no clear directional guidance yet formed. The overall weak pattern of the market has not undergone a fundamental change. From the perspective of market-driving factors, the trend of the U.S. dollar index remains the core variable affecting gold prices on the day. Although the U.S. dollar index has fluctuated recently, it still stays at a relatively high level overall, exerting obvious pressure on gold priced in U.S. dollars and directly restricting the room for gold price rebound. In addition, although the market panic eased further last Friday, investors are still affected by the previous collapse in gold prices, and their cautious sentiment has not completely faded. Buying orders are hesitant to enter the market with insufficient volume, leading to the failure of gold prices to continue rising after gapping up, with rebound momentum quickly fading and a pullback occurring, making it difficult to break the oscillating pattern. Market focus remains concentrated on the upcoming U.S. non-farm payroll report, which has been delayed to February 11th. Before its release, investors generally chose to wait and see. At the same time, the follow-up progress of the U.S.-Iran talks, changes in the Russia-Ukraine situation, and tensions in the Strait of Hormuz remain potential influencing factors, which affects the flow of safe haven buying at all times and indirectly determines the short-term trend of gold prices. From a technical analysis perspective, gold prices are currently in a weak oscillating consolidation phase. Various indicator signals confirm each other with the market trend, showing that short-term bullish momentum is still weak, and it is difficult to form an effective breakthrough. In terms of indicators, the RSI index is currently in the neutral range of 45 to 50, with no obvious overbought or oversold signals, indicating that short-term long and short forces are relatively balanced. The green column of the MACD indicator has shortened slightly, but the red column has not yet formed. Although bearish momentum has faded, bullish momentum has not yet risen. Further cooperation of trading volume is needed for a rebound, and it is difficult to reverse the weakness in the short term. In terms of key support and resistance levels, for support levels, the first short-term support level is focused on $4,968, which is the intraday low of the day, and also close to the previous intensive oscillating trading range. If this level can be held steadily, it can avoid further declines in gold prices. The strong support level is focused on $4,950, which is an important support level for the previous rebound. If $4,968 is broken, gold prices are likely to quickly test this level, and if it is further broken, they may approach the $4,900 integer mark for resistance levels. The first short-term resistance level is focused on $4,988, which is the high point after the morning gap up. The core resistance level is focused on $5,044, which is the intraday high of the day and also a previous oscillating pressure level. If it cannot effectively break through this level in the short term, it will be difficult for gold prices to open up further rebound space, and they will remain in a range-bound oscillating trend. All content is for reference only and does not constitute any investment advice. If you trade based on this content, you should bear your own profits and losses. Please subscribe, like, and share. Thank you for watching.